Thank you, Sung-Ho. Thank you, Governor, for a very inspiring speech, which very neatly sets up some of the ideas that I'm going to talk about myself. And I thank the organizers and the Bank of Korea for this honor that they've given me in presenting the keynote address here. It's I've been in Seoul quite a few times before, and I always enjoy coming back here. I am not an expert in the details of Asian finance, and I'm talking to a group that are experts. So my discussion and keynote address will be mostly concerned with kind of general issues in the economics of financial integration, what we know, what we thought we knew, what we know now that we didn't know before, and so forth, and some of the research that is being done in the area, including some of my own research with some of my students. So let me see if I can work this. Okay, so let me just start with some of the kind of background, more or less the research on financial integration before the financial crisis of 2008, 2009. I mean, this has been an area that has had really a substantial research over many decades. And the kind of questions that I've asked are whether financial integration increases the allocation of resources over time, in particular whether it increases economic growth. In addition, we expect that financial markets should foster risk sharing among countries. Now, there is a very large empirical and theoretical literature dating back many decades examining these questions, and I have to say the answers are very mixed. In fact, some of the people who have contributed to this area are in this room. In terms of growth, I mean, if we think about it, there's very little evidence that the fast-growing emerging market countries are the ones that had very open financial systems, at least in the beginning. If we look at the cross-section of countries, we don't see that, countries that were financially integrated into world markets grew faster. I mean, if we think about China and so forth, that's clearly not true. There is some evidence that opening to financial markets has a short-term effect on growth, and we have kind of capital inflow generated growth. But against that, this evidence is even mixed because many of the growth episodes have been followed by crises. So on the growth dimension, there's mixed evidence. On the risk-sharing dimension, there's also a bit of mixed evidence. There's no clear evidence that financial market integration enhances the consumption risk-sharing across countries. There's a very large literature on this, a literature which incorporates the role of real exchange rates, and again, the evidence is fairly mixed. Now, maybe the problem really is that economists weren't looking at the right things or looking in the right places, and a nascent literature grew up in the mid-2000s, which focused on kind of other things than just looking at growth or risk sharing, the kind of product of financial markets, but looked at kind of indirect effects of financial liberalization, like the indirect benefits might be due to improved policy performance, better governments, better financial governments, improved institutional structure, and so forth. And there is some evidence that financial integration does help along those lines. Now, that was kind of a 2-minute summary of the pre-GFC kind of focus on financial integration and the benefits. Now, after the global financial crisis, I think there is a really a kind of a sea change in the understanding and appreciation and caution that economists handle the examination of financial integration. So it is clear that we know clearly that the global financial crisis originated in financial markets, and the propagation and contagion was very important through the financial markets, especially through the banking system. Evidence suggests also that the worst hit countries in the immediate crisis aftermath were the ones that had higher capital inflows, higher current account to GDP, current account deficits to GDP. This whole episode led to a really significant shift in the consensus views on the benefits of financial integration. Now, economists in advanced economies are much less sanguine about opening financial markets. One thing to note, of course, is that many economists in the Asian region will know that many of the lessons that we relearned in the global financial crisis had been learned by economists in the Asian region and in other emerging markets in the series of crises in the 90s and early 2000s, including issues like high financial leverage, domestic credit booms, excessive asset appreciation, maturity mismatch. All of these things were elements that were seen before the financial crisis, but now I think we have a deeper understanding and a more aware attitude of the dangers involved here. Now, how have financial markets done following the global financial crisis in some broad sense? Well, one of the key attributes of the global financial market in the past few decades, as you all know, is the huge explosion in gross positions, gross assets and gross liability positions of countries have grown at breathtaking rates every year over the past few decades. Now, for the first time ever during the financial crisis, there was a sharp correction in that, and gross positions both on the liability side and the asset side on the external dimension fell sharply. But this turned out to be just a temporary fall, and if we look at the top 10 portfolio holdings, this is external portfolio securities of the top 10 holders in the CPIS data, the fall in this tended to be was just a transitory fall, and it kind of bounced back, not quite on trend, but we're seeing similar growth rates to what we'd seen before. It's even more impressive for Asia. For Asia, the fall was quite temporary during the GFC, but Asia is back to trend now, or even above its trend on portfolio assets. On the liability side, Asia is down a bit, essentially in a macro sense, indicating that Asia has continued to run substantial surpluses following both pre- and post-financial crisis. Okay, let me talk about some of the post-crisis research, and including I'll talk about some of my own research. Now, I think after the financial crisis, there was both a huge growth in empirical and theoretical exploration of the kind of underlying dangers of financial markets, both domestic financial markets and international financial markets. And a way to kind of summarize this, I think, is that the research has explored the twofold nature of financial markets. International financial integration does offer gains from risk sharing, resource allocation, maybe gains in terms of those indirect gains in governments, policy, institutional gains, and so forth. But we also understand that there's a risk of financial contagion. Now, many of the papers, both empirical and theoretical, have tried to dig deeper into this kind of twofold nature, the opportunities and the dangers. And I'm going to present some work of my own which tries to capture this and tries to look at the balance of gain and against losses. So the plan of my presentation for the next 36 minutes is to present some recent research that I've done with one of my former graduate students on the effects of financial integration in the presence of domestic financial distortions. Because the key message that comes out of a lot of the literature is that, our previous analysis of the gains from financial integration and opening financial markets, financial liberalization, had ignored messages that were given many, many years ago, which was that when you have domestic distortions, when you have a distorted financial system in place, opening to financial markets is not necessarily a good thing. In fact, Ron McKinnon was saying this back in the 60s, but economists have kind of had to relearn this lesson, but they relearned it with a vengeance in the past few years. So I'm going to be presenting some of this work. Then I'll discuss some of the empirical implications and validation of this work. Then I want to discuss some of the policy implications. If we do recognize that the future is definitely in the direction of financial liberalization, what kind of policies do we need to put in place to make sure that liberalization is not followed by crises and crashes and contagion and so forth? Then, if I have time at the end, I'll just kind of say a few words and conjectures about avenues for future research and areas that academics and policymakers have to think about important kind of unexamined issues in financial markets and economic policy. Okay, so let me talk for a few minutes about some of my own work. This is work that I've been doing with one of my former students, Changhua Yu, who's now at the University in International Business and Economics in Beijing. And what we do is give an analysis of the trade-off between gains from financial integration and the risk of financial contagion. And the basic idea, it's a quite an involved paper with lots of computation and so forth, but I'm not going to take you through any of that. The basic idea, though, is to look at, recognize that financial integration can help to share risk across countries. But at the same time, this sharing of risk and reducing the risk has a kind of a moral hazard dimension. It encourages risk-taking. Now, risk-taking is kind of a loaded word in value terms. It suggests, it's not a good thing to do. But risk-taking is what we want people to do in economics, because we want investment, and investment is always made under uncertainty. So risk-taking is good in general. But in the presence of financial fragility, and financial fragility in our perspective will be presented in the form of kind of a balance sheet weakness. In the presence of this, agents don't fully internalize the consequences of their investment behavior. So in that case, risk-taking can have negative spillover effects. And they're the kind of key message that I want to emphasize in this, that there are gains, but because of the presence of externalities due to these financial distortions, we have to be careful about the potential losses. The research is based on a general equilibrium model, which I don't really need to go into in any detail, and it's what we call a kind of a global stochastic solution method. Now, the essence of this method, relative to what has been done before, is to emphasize the element of risk in decision making. So this is what we call a higher order solution approach to equilibrium models. So it's looking at the effect of various policies on the riskiness of the economic environment and the actions that agents take when the background risk of the environment is increased or decreased. So, and then what we do in this is look at a very simple exercise. We compare different degrees of financial market openness. And within these different degrees of financial market openness, we look at the contagion properties of each structure. And what we define contagion as a situation when a crisis in one country spreads to a second country, by definition, contagion really cannot take place unless we have some kind of linkages in financial markets and open financial markets. Now, there is a very, very large literature both on the theory of international financial markets and on the empirical examination of the properties of capital flows, financial markets, asset prices, and so forth. I don't really have time to go into the details on that literature, but let me just say that some of the work this work that I'm presenting here is a follow-up of a paper with my esteemed colleague James Yetman from the BIS in Hong Kong, a paper we did a number of years ago. So again, let me just have one comment about the environment, just so as that you kind of know what I'm talking about. We have a model with borrowers and lenders. Any of the recent examination of the theory literature in financial markets has to have some kind of leverage, because borrowing and lending is the kind of key aspect of the effect of financial integration in our paper. We have investors accessing a technology. Investment is financed by debt, by borrowing, and there's some kind of fixed asset that investors use to make investments, and this fixed asset is more productive in the formal sector than in the home sector. So, ceteris paribus, we want more of this fixed asset to be used in production, and that's a good thing. Now, what is the financial fragility or the distortion in the model? The distortion is due to the presence of moral hazard, where borrowers cannot be forced to repay unless the loan is collateralized, something which is very common in the real world. So that the debt in the model has to be limited by the recovery value of assets. Now, what kind of experiment do we do with this model? Well, we do a very, very simple examination of the effect of a series of different financial market structures to see how these affect investment, risk-taking, contagion, and crises. And we look at three different structures. And these are very highly stylized. So let me say at the beginning, we're not trying to capture in any way the complexity of the global financial system, the role of banks, financial intermediaries, shadow banks, the FX market, so forth. None of this is captured in our model, but we do, I think, capture the essence of what we're talking about when we think about financial integration. That's the role of foreign financing of investment. So with this, we compare three different structures. There's what we call financial market autarky, where essentially we have an economy that is completely closed to financial markets, no portfolio diversification, and all investment is financed with domestically raised money. Then we have partial integration, a debt market integration, where equity flows are still controlled, but investors can raise investment finance on world capital markets. And then finally, we compare this with a full financial integration where both equity and debt markets are integrated, and investors can borrow from a global bond market and hold equities in any country. So I can briefly say this, and I'm not going to try to explain the algebra here, but the key financial constraint is that borrowing is constrained by the collateral value of assets. So we have a leverage constraint on borrowing that can be raised to finance investment. Now, this is the key kind of financial fragility in the model, and it means that when investors tend to be constrained by this borrowing constraint, we can have a fall in asset values, what they call a fire sale in existing assets, and this can lead to a collapse in investment and the real economy. And the key thing that we stress in this is that this introduces the possibility of financial linkages across countries, in that if collateral that is a claim on foreign capital or foreign equity is posted to finance a domestic loan, then a fall in foreign asset prices can lead to a tightening of domestic balance sheets, and we can have this contagion across countries. So I can skip that. Now, let me just briefly show you what we get out of the model economy that we simulate here. We just say, let's take two countries, and let's say these countries are subject to random shocks. We call them productivity shocks. And there are three such shocks in the model. We have a low, a medium, and a high shock. This is simply for exposition. Here we can have a much more complex shock structure, and we assume that the shocks are independent across the countries. Now, I'm going to show you just very briefly some of the simulations and the implications of this model for the frequency of crises and the degree of contagion in crises across countries. And the question really is, how is contagion affected by the degree of financial market openness? Should we expect that financial market openness leads to a greater contagion of crises? Secondly, how will financial market openness increase the frequency of crises? With open financial markets, should we have more crises than otherwise? So let me just show you this pie chart here. This is what our simulations look like when we have no financial markets, when we're in autarky. And the purple space is normal times, when we're not in a crisis. The red slice is the frequency of times when the home country is in a crisis. The green is when the foreign country is in a crisis. And the blue sliver there is when we get contagion, or we get joint crises, both countries in a crisis together. So what we see here is, if we have no financial market integration, we do have crises because we have these domestic financial constraints. We have bad shocks, and these borrowers tend to be constrained when they're in a bad shock, and we have severe recessions. Let me just say, the numbers here, the calibration, is not supposed to represent reality in any extent. This is just an experiment. This is not, we're not saying this is the number, that this is the empirical frequency of crises in the real world. But the key thing is, I want to compare this to what happens if we open up financial markets. In particular, the question is, how is contagion affected by financial markets? So if we look at the blue sliver there, we see there's almost no contagion. Now let's open up bond markets. Now we get really a significant increase in contagion. We have the periods of no crisis are still the norm, but we have very few episodes when we have a crisis in one country, either in the home country or the foreign country. Most of the episodes of crises are joint crises. So we get a lot of contagion when we open up with bond markets. Now let's open up to bond and equity markets. That is essentially full financial integration. Now we have essentially full contagion. That is, if we have crises in one country, we tend to have crises in the other country. The additional feature we find from the model is that financial markets tend to increase the probability of crises globally. This picture shows for each of the possible shocks, the low shock, the medium shock, and the high shock, the probability of the crises occurring, that is, binding constraints. The blue is for the no financial markets, red for bond markets, and green for bond and equity markets, and we see the probability goes up. It's more likely that if you're in a very bad state of the world, the low state, you'll have a crisis. But when you open up to financial markets, it's more likely still, and we see the probability increases. Why do we get this? Why does financial market tend to increase contagion? Well, that's not hard to see, because we get these linkages among investors. We get linkages on the liability side because we're raising funds now in a global financial market, and negative shocks in one country tend to tighten credit conditions across markets. We get linkages on the asset side because a negative shock in one country leads to valuation changes and deteriorates the collateral position of posted collateral in all markets. So we get these financial market linkages which tend to increase contagion. Why is it that crises are more likely? Well, in our model, crises are more likely because opening financial markets tends to encourage more borrowing. Why does it encourage more borrowing? Because it reduces overall risk, and this reduces the kind of the riskiness of borrowing itself. It also tends to increase equity prices. The increase in equity prices tends to improve the value of collateral. This joint process tends to increase leverage. So if we see the bottom table there, as we open financial markets, we have an increase in the overall leverage of the financial system, as borrowers in both countries tend to raise more funds to invest. Now, that sounds like it's a very bad option for a country to open up financial markets, but there is a countervailing fact to that in our model. While crises are more likely, they're also much more severe. So these pictures show the volatility of output that we find in a crisis, when the country is in a crisis. So if you, what I've shown you is that it's more likely that you'll have a crisis in international finance, with connected international financial markets, but if you have a crisis, output volatility will be much less severe. So crises are less costly if you have international financial markets. Okay, so that's basically the result of our modeling exercise. It's that there is this twofold nature of financial markets. They do spread contagion. They may increase the probability of crises, but the crises themselves are less severe. So there's gains and losses. How about the empirical evidence in support of this? Now, there's our paper is unfinished, so we haven't done fully the empirical part, but I'm going to talk a little bit about previous work that has been done on the relationship between financial liberalization and crises. Now, most of the work in this area was done pre-global financial crisis. There is a very large literature that looked at the impact of financial liberalization on emerging market crises, on banking crises, exchange rate crises, balance of payments crises. And the evidence from emerging markets, it definitely says that financial liberalization is often associated with crises, currency crises, banking crises, or sometimes the twin crises. The evidence does say, though, clearly that it depends upon the robustness of the financial system, with more robust financial systems, more regulated systems, less financial fragility, the occurrence of crises post-liberalization is much less. Secondly, there's some important recent work which suggests that something which implicitly we have in our model, that while financial integration increases crises, it also increases growth even more. And so on the net sense, the positive growth effects tend to dominate. So even though your vulnerability to crisis is greater with financial integration, your growth opportunities will outdo that. The second question that we could ask based on our modeling exercise is whether financial liberalization increases leverage and credit growth. Now, for this, actually, currently this semester, I'm visiting the BIS in Basel, so I've been having lots of discussions with economists there about the BIS view. And the BIS view very unambiguously connects the open financial markets with increased risk-taking, increased leverage, and credit inflows and capital inflows and credit booms. The view, for instance, of Claudio Borio is that financial liberalization tends to kind of increase the elasticity of the monetary system, encourage risk-taking. That's an element which we do capture in our model. This is also supported by some work by Bruno and Hyun Shin, recent work looking at the role of global banks and the risk-taking that they engage in. Let me just point to some work that was done after the financial crisis on the link between credit booms and debt and capital inflows through the banking system. A recent paper by Philip Lane and McQuaid looked at looking at across both emerging markets and advanced economies, saw a very strong positive correlation between net debt inflows and domestic credit growth in a wide sample of countries. So basically what was happening before the crisis is that a lot of credit growth in many countries was being financed not with domestic deposits but with capital inflows. The interesting thing about this is that these were debt inflows. There's essentially no relationship if we look at equity inflows, but the debt inflow relationship is very strong. So this is for a group of 54 advanced and emerging market economies, and the relationship with net debt inflows on the horizontal and the growth of domestic credit on the vertical. So there is clear evidence, I think, that financial integration, financial openness does tend to kind of encourage risk-taking, if we can define this as such. Finally, is there any evidence contrary to this evidence which is suggested by our model, the evidence that if we do have crises with open financial markets, the crises themselves tend to be less severe? This is a very hard proposition to test because it's a kind of a conditional statement. But there is some evidence that in following the global financial crisis, that the countries that were worst hit, the countries that were least worst hit were the ones that had capital market linkages to the U.S. This is somewhat paradoxical and surprising, but this comes out of a paper by Andy Rose in 2011, suggesting that kind of if we just look at indices of financial openness following the crisis, then there's really no relationship between the severity of the downturns in the GFC and financial openness. But if we look at the countries that had capital market linkages to the U.S., then there is some suggestion that those countries did less worse in the immediate aftermath. There's also some kind of more speculative suggestion that the U.S. playing a very, very special role in the global financial market acts as a kind of a global insurance mechanism for countries that are connected through international capital markets. This is a suggestion of Pierre-Olivier Gourinchon and Ellen Ray that the U.S. Acts as a crisis insurer, and the evidence that they have for that is that immediately following the global financial crisis, the sudden strengthening of the U.S. dollar meant a huge capital loss on the U.S. external portfolio, which was actually of the order almost of 20% of U.S. GDP. Intuitively, this is because the U.S. There's a really significant amount of dollar-denominated U.S. debt held by non-U.S. countries, and the U.S. external asset portfolio experienced a really significant deterioration because of the fall in equity markets. So this is kind of a speculative suggestion that financial integration can have this kind of global insurance property. Let me talk briefly about some of the policy implications which comes from our model and other work that has been done in this area post-financial crisis. The financial fragility, the kind of balance sheet linkages that I've been talking about, introduces a classic externality. This is an externality, a textbook externality of the kind that we teach in microeconomics. This externality tends to encourage overborrowing and excessive risk-taking. Now, it can be corrected by capital flow controls. We know that in a textbook sense, if we have an externality, then there's usually a policy that can be used, a tax or quota that can be used to correct this externality. Now, many writers have suggested that capital inflow taxes can be used as macroprudential regulation to avoid this overborrowing, avoid excessive risk-taking and financial fragility. Let me kind of give you a little kind of explanation of why that would be the case. If we think about, first of all, with frictionless financial markets, there's the marginal benefit of borrowing in terms of domestic investment should be equal to the world marginal cost of funds. And so there's no role for policy there because these two things are fully efficient. Now, with these capital market frictions or balance sheet constraints, then to an individual borrower, the marginal benefit of funds is equal to the world marginal cost of funds plus some additional external finance premium. Because of financial fragility, lenders will charge some additional cost to borrowers, so there'll be a spread between the benefit and the cost of funds. However, the right-hand side here is the cost to the private borrower. It's not the social cost. When we have the possibility of financial fragility, there's an additional social cost. The marginal benefit of funds should equal the world marginal cost of funds plus the external finance premium plus the marginal change in financial fragility. The idea is that the individual borrower imposes a pecuniary externality by increasing the risk of a crisis. Now, this affects the cost of funds for other borrowers. This possibility of a crisis has a spillover effect, which is not taken into account by individuals. So again, it's a classic externality. Now, in the presence of balance sheet constraints, this externality is a first-order thing, and it does introduce a role for policy. Financial regulators can internalize this externality with a capital inflow tax. So there's been a significant number of authors have suggested that a motivation and perhaps a rationalization of the use of capital inflow taxes. Now, we know that capital inflow taxes have been used by a number of emerging markets in the past few years. So perhaps this gives kind of a strong reason and a defense and a rationalization of these. Let me suggest, however, some doubts about this. If we actually look at the evidence on the use of capital inflow taxes or capital controls that have been used by some of the large emerging markets in the past few years, they bear very little relationship to these types of macroprudential policies that are implied by this literature on financial fragility. So a number of recent papers, one by Michael Klein, show that there's really no evidence that capital inflow controls have directly targeted financial fragility itself. They've more or less kind of targeted aggregate variables like growth or the exchange rate or something. A recent paper by Kristen Forbes and Marcel Fratscher looked at Brazilian inflow controls on debt, and these were very, very kind of particularly designed controls that they weren't kind of a broad brush controls. So they were kind of in some sense the idyllic experiment in macroprudential controls. But the interesting thing about these controls is that even though they were targeted on debt inflows, they had equally strong effects on equity inflows, which was bizarre and really unforeseen. So what it suggests is that our kind of knowledge of the effect of capital flow controls is very, very rudimentary, and that if we do try to use them for macroprudential policy, they're likely to have some kind of other effects that surprise effects. A second thing about the Forbes-Fratscher work is that these capital flow controls had spillover effects to other emerging markets, and so we can't simply think about policy in one country when we look at in capital controls. We have to think about more the global effects. Let me now kind of shift gears a little bit in the last few minutes to talk about some areas that I think are important for future research on financial integration and global financial markets. One of the things that I think is very poorly understood is the role of global financial networks. Now, if we look at the empirical literature on global banking following the crisis, we see that there were very, very complex cross-country bank linkages. These interbank linkages can harbor financial contagion that is very hard to know ex ante. So, for instance, the global financial crisis amplified this very complex relationship between U.S. and European banks. Hyun Shin and co-authors have emphasized that in recent writings. The important thing is that it's really hard to see this ex ante. We don't see it, for instance, in net flows. Now, what message does that give us? I mean, what in terms of the follow-up research? Well, I think it suggests that we really have to understand the role of financial networks. And let me just point to an important path-breaking paper by Franklin Allen and Douglas Gale in 2000 on financial contagion, which I think was relatively understudied in at least among the macro profession. They show that the shape of the interbanking network is really crucial for financial contagion. Contagion risk may be completely hidden, even if there's zero net liabilities, but the gross liability structure is really the important thing we should be looking at. Another result that comes from Alan and Gail is that a more complete network is generally the best type of network. Now, with that, let me give an example from Asia, and this relates to some of the governor's discussion just a few minutes ago. There is, as the governor suggested, and as was suggested by Director Curry at in the beginning, Asia has relatively low kind of intra-regional financial linkages. Now, as a measure of this, there was a paper by Bornstein and Prakash Lugani in 2011 looking at intra-regional investment linkages in Asia. And this was with data up to 2007, just before the crisis. Now, what I did is I went back and looked at the more recent data up to 2013 to ask how have these intra-regional investment linkages increased. And this is again based on the CPIS data. So if we look at the share of portfolio holdings in Asia among these Asian economies, the blue line is 2007 and the red is 2013. Well, it's increased very, very slightly. This is for all assets, including both debt and equity assets. It's risen from 13% to 15% in these 6 years. But if we look at equity securities, which really are we think, facilitate more of the risk sharing between countries. Equity securities have increased for some countries, decreased for other countries, but on average they've been staying constant at 15%. So the message I'd give is that, that there hasn't been, in the aggregate at least, a lot of increase in kind of intra-regional financial connections in Asia. I think I'm pretty much out of time. I do have one final additional kind of area for research that I think is important on the global monetary system and the possibility of spillovers between countries and the connections between monetary policy, capital flows, risk-taking. I think this is, again, something that's being pushed by people at the BIS. I think it's an important question, at least for study. Okay, let me just finish now with some conclusions. I would say the profession, at least the academic profession, and I'm presuming the policymakers also, have been very deeply affected in their thinking about financial integration by the global financial crisis. I think we understand much more the vulnerabilities of financial market liberalization, that there's both opportunities and risks to a much greater extent than we did. I think there's a greater appreciation of the role of transparency. There's clearly a greater importance put on an adequate regulatory framework, both domestically and internationally. But I would say that typically developments in financial markets in the real world move faster than our understanding. And so there could be new dangers lurking as financial markets evolve. Okay, let me finish there. Thank you very much.